Have you ever thought about this? There's an investment strategy where you don't buy the house, you buy the money someone owes the government. It's called tax lien investing. Here's how it works. When a homeowner fails to pay property taxes, the government auctions off that unpaid debt. When you buy it, you become the creditor. It's like you paid the taxes for the owner, and in return you receive a document called a tax lien certificate, essentially a government-backed IOU. The homeowner must then repay you the principal plus interest. Is the interest high? It can be. Florida goes up to 18%, New Jersey up to 12%, Arizona up to 16%. In some states, investors bid the interest rate down, and whoever accepts the lowest rate wins. If you're willing to take 5%, you get the lien. But what if the homeowner doesn't repay? You may have the legal right to foreclose and transfer the property into your name. That means you could end up owning the house, sometimes far below market value. Sounds like guaranteed profit? Not exactly. This isn't fast money. Every state has a waiting period, from months to years. Florida's about 18 months. In New Jersey, it can take around 2 years before you can even start foreclosure. Another key point, you must know which tax year you're buying. In New Jersey, auctions are held once a year, and a property may have unpaid taxes from multiple years. Only the earliest lien gives you the strongest position to eventually acquire the property, because foreclosure rights start with the oldest lien. If you buy a later year lien, and the earlier one hasn't been redeemed, you're stuck unless you also purchase the earlier liens, which increases your cost. That's why we generally recommend focusing on first-year liens. What about title issues? In most states, tax lien foreclosure can wipe out mortgages and many other debts, and the property is often transferred with clean title. Still, many investors run a title search, especially on higher value properties. So where do you buy tax liens? It depends on the state. Some auctions are online, others are held in person at county offices. The process is straightforward. Register, submit a deposit, bid, and win. But each state has its own rules. Strategies vary. Some investors focus only on earning interest. Others target lower-priced properties where redemption is less likely. To summarize, tax lien investing isn't traditional real estate investing, it's debt investing. You earn interest, and if the owner doesn't redeem, you may acquire the property instead. Every state is different, so you must do your homework. We generally don't recommend buying later year liens. Focus on the earliest year. When done correctly, this can be a low barrier, high return alternative investment strategy. If you'd like to learn how we evaluate and select liens, or you're interested in trying this strategy yourself, leave a comment or reach out to us. We'll continue sharing real case studies and practical insights.